The Swedish OMXS30 looks weaker than ever before, and a rare shorting opportunity lies ahead. One that might set off the next vertical waterfalling movement. As announced on multiple occasions in my previous technical episodes, I looked at taking shorts at the 1580 and 1660 levels respectively. And since I put my money where my mouth is, I did take such a short position at the 0.5 fib cluster resistance, which is already in the green due to the price being rejected. Given that I, for personal reasons disclosed in detail in the early episodes on this channel, play the markets with a much higher risk profile than traditionally advocated, I entered a short with 30% of my account at a 2.8x leverage, which at the time was the lowest leverage available for futures. But before anything, do note that nothing in this video is financial advice. Do your own research prior to any investment. And if this episode helps you at all, please like and subscribe and share it with others who may benefit from hearing this. For each episode comes to life through procrastination and pain. Now, as thoroughly outlined in previous episodes, I don't expect the market to recover anywhere above the cluster resistance level for quite some time to come. If anything, I expect prices to gradually find their way down, which is also why I have positioned myself for such an outcome. But as a swing trader, I want to utilize as many technical turning points as possible. And having taken a deeper look at the current technicals, I don't expect us to immediately dip down and retest or even break the previous bottom at around 1260 just yet, as some of my trading colleagues believe. That would be a bit too obvious, for once we begin to head south, people en masse will expect a double bottom. But given traditional market sentiment, prices rarely take the obvious route. What I do see as an increasingly possible outcome, on the other hand, is for some sideways movements for some time to come. And by some time to come, I mean at least a few weeks. More on that later in this episode. In this episode, we will discuss three things. We will talk about the Swedish OMXS30 and how it is steadily weakening from a technical point of view. We will talk about some possibly expected sideways movements ahead, which affects any target levels of swing shorts. And most importantly, we will discuss a rare short entry possibility. A mouth-wateringly juicy risk-to-reward opportunity that I personally observe intensely in order to add to my current position. Now, let's get straight to dessert, but before that, do bear in mind that the cluster resistances discussed at length in previous episodes are still as valid as ever. In this part, we will rather discuss the technical additions as to why the OMXS30 looks weaker than before. After having traded in the bullish RSI channel, the RSI has beautifully bounced on the upper bearish blue line, in fact as clean as they get, right after the bearish channel was confirmed. We are now trading within the bearish RSI channel, and looking solely at this very channel, the OMXS30 shows no mid to long-term strength whatsoever. And given what we see, we may very well be in for a big move to the downside within a not too distant future. For this reason, the technical prospect of staying below the cluster level of resistances is even stronger now than before. But to prove my point, we need to look at some historical dead cat bounces prior to crashes. By doing so, we notice that the previously strong RSI channels quickly changed tunes and rather immediately positioned themselves within the bearish blue channels. We saw this at the peak of the IT crash in 2000, followed by some wild distributional sideways movements before breaking down. We saw it prior to the 2007 crash. We saw it prior to Bitcoin's significant markdown. We saw it in fingerprint cards on the weekly. I could go on and on, for this is a repetitive herd behavior. And it works with uncanny precision because few technical traders know of it or how to use it. For most traders have a vague idea at best of how to utilize the RSI to the fullest. Perhaps I'll make a full episode on the promised land of the RSI at some point. But for now, the reason why I bring up these weekend RSI levels now hovering around in a confirmed bearish channels on the daily is to stress that the upside potential is now even more limited due to a 5-inch thick glass ceiling right above us. And if there is anything you should take away from this episode, it is this, so listen carefully. Having changed from a strong bullish channel to an immediately weak bearish one at or near a market top or in a confirmed distribution phase is exactly how the markets have generally behaved historically prior to any severe markdown. It's the most straightforward warning, clear as crystal. If you go long now with a position trade, as in one to keep for the mid to long term, it's at your own discretion. You've been warned. Added to this weakened market narrative is the fact that we have had a long bearish RSI divergence on the monthly chart, one which very importantly does not seem to be able to break the bearish upper blue RSI line. Compare this to the American Dow Jones Industrial, where both the 2000 IT crash and the 2007 housing crash were preceded by dire bearish RSI divergences and an Asperger perfect distributional test and rejection from below of the upper bearish blue line, upon which the real crashes were initiated. Look at this. And we now see these copy-paste behaviors in the making with another grotesque RSI divergence on the monthly and a steady and gradual recline back up to the upper bearish blue line. Once we hit that level, particularly if it were to coincide with any cluster of resistance levels, you might as well put on your helmet, for we could be in for a gut-sucking ride all the way down to not the basement but to a bloody bunker. Moving on to part number 2, the likely expected sideways movements. But before disclosing them in full, there are 2 reasons why possible sideways movements, however temporary, are relevant at all. First of all, they affect any swing short targets as the likelihood of an imminent double bottom decreases. This forces me and any other technical traders who have taken short positions to increase our targets in order to secure and optimize profits. Secondly, short to mid-term sideways movements are relevant to every market participant in the sense that global indices will gradually cease to lead individual stocks. During the February-March plummet, the global indices sucked down pretty much every single stock with them into a seemingly black hole, completely disregarding any company fundamentals or bright prospects. With sideways movements, company stocks will rather resort back to normal behavior. This, of course, is good news as individual company fundamentals will be back in play. At least until we get the next collective vertical panic drop. Extreme RSI moves in general, especially when accompanied by below normal trading volumes, are typically a confirmation of sideways or range-bound movements, or of formation creations such as triangles, pennants, etc. etc. And this is exactly what we have seen in the OMXS30. Just compare it to the RSI behavior during the February-March crash and we'll quickly notice that its downwards RSI movements were quite minimal in relation to the actual percentual price drops. And of course, this is typical RSI behavior for any waterfalling movements, as opposed to this extreme move from 75 down to 27 from a single range-bound move of a few percent. A textbook example of wild across the field RSI swings is Fingerprint Cards' year-and-a-half-long sideways movements where the RSI has flung wildly from one extreme to the other. And what has happened to the Fingerprint Card stock price in the last year and a half? You got it, sideways movements. Add to the mix that throughout the 7-week 27% markup on the OMXS30, the price has continuously respected the EMA 200 and the green Ichimoku Kumos. Now, on the other hand, we have sailed through them both and are on our way back above again. Flailing back and forth between EMAs and Ichimokus in combination with wild RSI swings are textbook indications of either confirmed sideways movements or formation creations. Thirdly and most important, I will now outline an utterly interesting shorting opportunity ahead. Now listen carefully, for this is something I doubt many of you know of. What I'm about to share is something quite rare that you should not expect to come across too often during your trading career, but yet something of high reliability. Here goes. When you trade in a distribution phase, prices tend to swing generously from one side to the other, all the while the moving averages crisscross each other. Over the course of the 5-year-long OMXS30 distribution phase, the EMA 50 has crossed below the EMA 200 no less than 5 times on the daily chart, thus causing 5 so-called death crosses. 5 times is the amount of times the EMA 50 can cross below the EMA 200 before a markdown is statistically fully mature, and after which a significant markdown is to be technically expected. It's a dire warning of bearish times ahead. Technical author Thomas Bulkowski talks about this at length for anybody who wants to read up more about this theme. The point is that during the March plummet, the EMA 50 crossed below the EMA 200 for the 5th time. And the next time the index price hits the EMA 200 from below is the ideal money spot to go short. Now, here's the thing. The average retest of the EMA 200 after a death cross has occurred takes place after 50 bars. This number, though, should be taken with a big grain of salt, as it is quite unreliable. Yet it is an indication of what to roughly expect from a trending market. For do note that a retest of the EMA 200 is not relevant in a distribution phase or sideways markets, only in markups or markdowns, however early. Now, given the low angle of which the EMA 200 is coming down, and combined with the fact that a retest of the EMA 200 statistically should be expected sometime between late May and mid-June, it would be unlikely for prices to go down too much, as that would require another V-shaped recovery. Of course, don't get me wrong, a second extreme V-shaped bounce could still be in play, but the more people expect such passing of events, the less likely it is to actually happen. But as long as prices hover around sideways for a few weeks, it will constantly be close enough and in the neighborhood for a final EMA 200 retest without having to move much. And given the downwards angle of the EMA 200, it should be expected to cross paths with the 0.5 fib cluster within a few weeks, which would also statistically coincide with the expected EMA 200 price retest. Now, I will personally add on to any shorts regardless once we retest the EMA 200 again. But if it were to coincide with other resistances, I will attack it with a bigger position and with higher leverage. As stated, this technical occurrence is a rare one. I searched through the entire Swedish OMXS30 graph, but without finding a single occasion on which this has happened before. Neither could I find it on any other index nor equity, at least not on the daily chart. To sum it all up, the RSI on the daily has now entered a bearish channel. When this has happened historically in distribution phases, it has been a clear warning to either get out or to begin laddering in short positions. Adding this to the cluster of index resistances above indicates an additional level of market weakness. Of course, anything can still happen, for just because the weatherman says there's a 98% chance it will rain tomorrow doesn't mean it will. But to put it bluntly, the chances of long-term and sustainable upwards movements have significantly decreased. If contemplating whether to buy stocks mid to long term, investing the same amount in slot machines instead may mathematically save you money. Not financial advice, by the way. Do not listen to me. I'm a fucking idiot. Secondly, there are clear technical indications that we may be in for some likely sideways movements. The hourly RSI swings wildly under normal trading volumes, which on their own indicate sideways movements. On top of that, we also have a literal cluster of resistances above, and in terms of going south just yet, a double bottom would, from a sentiment point of view, be a bit too obvious. Do note that I say obvious with quotation marks here. I'm simply outlining the technically most likely outcomes here. And I have personally increased my sell targets for my short position because of the decreased likelihood of an immediate double bottom. And finally, we are experiencing something rare. 5 distributional death crosses upon which the next EMA 200 test on the daily will be a grand shorting opportunity upon which I will personally add on heavily to any already existing short positions. All in all, the market shows plenty of weakness, and with a retest of the EMA 200, some steady and gut-wrecking markdowns are likely in play. That was all for now. Thank you and goodbye.